What is up, guys? Roger here with Vantage Realty and Home Loans. Thank you so much for joining me today. Today, we're going to do a forecast for 2022 when it comes to mortgage rates and the housing market. Now, here's why it's important to watch a video like this one, because let's rewind and take a look at a forecast or prediction that I made in 2019. Roll the clip.
Let's just go down this rabbit hole. What happens if rates go down by a full percent? Right now, rates are like 4.25%, 4.5%. So if they drop by a whole percent, you're looking at a 3.5% rate on a 30-year fixed loan. Even lower of a rate if you're doing like an adjustable or something like that. Like back in 2013, when I bought a house, I got an adjustable loan at 2.3%. So if we get anywhere near that number, as far as interest rates go, values are going to go up.
All right, so as you can see, I am no expert, but I do know a thing or two about forecasting real estate or mortgages because I've been in this industry for a very long time. So anyway, not to toot my own horn too much, but I was right on the money. Rates dropped to below 3.5%, 3.25%, under 3%, and we all saw the housing market went bananas. So let's do the same thing here. Let's jump into our forecast for 2022. All right, so here is the market forecast for 2022. But before we do that, let's do a quick recap of 2021. So we expected rates to rise at the beginning of the year and recover into the fall. Rates did rise through March and as we expected, but recovered earlier than we expected and dropped back down by late summer. So pretty accurate for 2021. The housing forecast, we had a strong demand and tight supply, and we thought home prices would go up 5-10%. It was way crazier than that. Home prices went up between 10 and 20%. Some areas like Phoenix, Seattle, and so on went up 20%. Most places in Los Angeles went up 10 or 15%. I recently had a client who bought a house for about $950 a year ago, did some renovations, just got it appraised $1.5 million. So it went from 900 and change to 1.5. It went up 50%. Now that's including some renovations and stuff, but still pretty drastic numbers. There's again still a very strong demand, very tight supply. The supply just keeps getting lower and lower, which causes values to keep going up. And then COVID's causing supply chain disruptions and labor shortages, which again is pushing values even higher. Okay, so here's the dynamics that we're looking at for 2022. Okay, so the Fed is going to play a major role. They've already announced that they're planning on having 3 rate hikes throughout the year. We'll see if that comes to fruition. Depending on how the stock market reacts, we'll see how that goes. So they're saying they're going to buy less mortgage bonds and they're going to raise rates. And then as those mortgages are getting paid off, they're not going to continue to buy more. So that's what a balance sheet runoff is. When these mortgages start getting paid off, there's room on the balance sheet for the government to buy more mortgage bonds. They're planning on not doing that. So we'll see how that impacts stock markets, interest rates, and all that good stuff. So we have some Fed voting members rotating each year. The voters in 2022 are looking to be less accommodative than 2021. We'll see how that goes. And inflation. Everyone's talking about inflation. Everything's going up, right? Inflation's going through the roof. We hear about it every single day. We're talking about gas prices, milk, eggs, bacon, everything's going up. So we'll see how inflation plays a part. Raising rates will curb inflation, but then the stock market reacts and sells off. We could see the Fed pull back and lower rates again. The Fed should have raise rates sooner to start curbing inflation. They're thinking it's transitory, which means it's going to come and it's going to go. Not a big deal, but we're going to take a quick look at history and help forecast how the Fed's actions in 2022 will influence the markets and essentially how that's going to impact you as a home buyer and how it's going to impact you as a homeowner. Okay, so let's do a little bit of a history lesson here. Arthur Burns, man, look at that. Anyone who splits their hair in the middle, automatically, I do not trust you. Unless you are Sean Hunter from Boy Meets World, I do not trust that haircut. That's number one. So in the 1970s, Arthur Burns was the Fed chair. He ignored inflation, which was rising rapidly. He said it's transitory. Again, that's what we're hearing these days. Oh, it's just transitory. It's going to come and it's going to go. Year over year, inflation ballooned from 7% in 1978 to 14% in 1980. That's crazy numbers. So 14% inflation. So The higher inflation caused mortgage rates to rise from 12% to 18%. So I know 12% today sounds crazy, but that was pretty normal back then. And can you imagine rates went up by 50%? That would be the equivalent of today, rates going up to over 5%. But again, this is what happened in the past. Again, I know 12% is crazy for a mortgage rate and 18 is even crazier, but inflation went up. Arthur Burns didn't do anything. Rates went from 12 to 18%. So now fast forward to 1980. Paul Volcker becomes the Fed chair. He raises the Fed's funds rate to 11% to 20% in 2 years, drops the inflation, right? Inflation goes from 14% to below 5%. So it worked. Raising the Fed's funds rate, dropped inflation, got it back under control. And because inflation dropped, mortgage rates declined from 18% back down to 12%. But the consequences were stock market sell-off. S&P declined 30% during that time, and the tighter money policy caused the US to go into a recession. Now, it's kind of like we're in a situation where it's like, we got to rip the Band-Aid off. We got to curb inflation. We got to go through a period of a recession, which again, it's not the end of the world. Recessions are normal. It's part of the cycle. So that's something I think we need to kind of understand is like, let's not all freak out, okay? Recessions happen all the time. Every about 8 years or something, there's a recession. So we've gone through before many times. We'll get through the next one if this is what happens moving forward. But this is the answer. Raising interest rates, curbing inflation, and then eventually, once inflation drops, rates will come back down. Okay, Alan Greenspan. Now we're in the late 1990s. Inflation again doubled from 1.75 to 3.5%. And that caused the mortgage rates to rise from 7 to 8.5%. So unlike Burns, Greenspan took action mid-1999 and hiked the Fed's fund rate from 4.75 to 6.5, same exact number as the inflation that had doubled. And inflation responded and dropped from 3.5 back down towards 1%, which is normal. Look at the face on this guy. I trust this guy. So mortgage rates, after raising the Fed's funds rate and after the inflation came back down, rates dropped from 8.5 to 5.5%. Again, there were consequences. The S&P dropped off by 50% from the spring to fall of 2000. US entered into a recession again. So this seems to be the pattern of what needs to be done and how we can get out of this inflationary period. Okay, so today under Jerome Powell, let's see what's going on. Inflation increased from 1.75 to 7%. So it 4x'd under Powell, and again, calling it transitory. Interest rates went from 2.5 to 3.3. The Fed is currently tapering their purchases of mortgage bonds and treasuries. They will not hike, but they will reduce the purchases at the same time. So they're not doing two things at once, right? They're not raising rates and reducing their purchase of mortgage bonds. So right now, they're slowly reducing the purchase of mortgage bonds, and in the next, few months, they'll probably raise rates. We'll see. So we're expecting that they'll be done tapering the purchase of mortgage bonds by March and likely to begin raising rates around May. Again, so we're going to talk about how this is going to affect you as a homeowner right now in today's market. Okay, so the Feds are targeting 3 rate hikes in 2022 and 2 or 3 in 2023. Inflation and interest rates can still rise until the Fed acts. If Fed can tame inflation, mortgage rates should drop, but maybe from higher levels. Okay, so let's do a quick recap. Here's the pattern. Under Burns and Volcker, Greenspan, Powell, inflation goes up, mortgage rates go up, which is what we've seen. Interest rates are going up. Actually, today we got an increase in mortgage rates. We're now around 3.25, 3.3. What happened to the Fed's funds rate? They went from 11% to 20% under Volcker, 4.75 to 6.5. Under Greenspan and Powell, it's going from 0 to 1% in 2022. And if we do that, inflation should drop back off and we should get back into a normal period. Okay, so again, mortgage rates will drop back down after the inflation is taken care of, right? So once the Fed steps in, raises rates, tapers inflation, inflation comes back down to normal, interest rates will come back down. Okay, so however, all 3 times, there's been a recession in the stock market. So we'll see what happens this year and if we get a recession this year in the stock market as well. Okay. So here's a few wild cards. Obviously, COVID. We don't know what's going to happen with COVID. There's going to be more cases, more hospitalizations, blah, blah, blah. Supply chain issues, employment issues that could, change the outlook dramatically. Additional stimuluses may fan flame inflation, could push stock prices temporarily higher, cause mortgage rates to rise. We'll see if there's going to be more stimulus. The runoff of the Fed's balance sheet. Feds are going to stop purchasing new bonds and treasuries. Then they're going to raise the Fed's funds rate. They're still buying $70 billion a month in mortgage bonds through reinvestments to keep rates low. Once they stop, rates could move higher. Okay. So again, one more chart to look at. All of the analysis, all of the statistics show based on past performance that stocks are at an all-time high. They're extremely overvalued. Stocks are extremely expensive. We're expecting the stock market to decline in 2022. It can't go up forever. So you guys hear that? Stocks can't go up forever. There needs to be a correction. Okay? There needs to be a correction at some point. So we expect that to happen in 2022. Okay, so here is our forecast and how this is going to affect you as a home buyer or homeowner. Okay, so we expect mortgage rates to rise along with inflation during the first part of the year towards 3.75. It's already happening within the first week of the year. We're seeing rates go up by about 0.25%. With the Fed's action, softer stock market, and slowing economic conditions, the stock market goes down, interest rates should head back lower in the second part of the year, back down towards 3%. So again, first half of the year, it's going to raise to 3.5%. And then at the end of the year, drop back down around 3%. So this sets up for bias of less upfront fees and opportunity ahead. Okay, so how this is going to affect you. So if you are doing a refinance today, right, especially if you're doing a cash out refinance, you don't want to pay points. Do not pay points because you're going to have an opportunity to refinance towards the end of the year in 8 to 9 months and drop your rate. So do not pay extra cash to get a better rate today, because as rates go up, inflation is curbed, rates will drop back down because the stock market will trend lower, rates will go lower. Okay, so don't pay points if you're refinancing or buying a property in the first half of the year. All right, now housing forecast. What's going to happen with housing? Housing is going to remain strong in 2022, but not as strong as 2021. I personally think it's going to be very close. It's still going to be very strong because there's so little houses on the market. It's ridiculous. Demand might be slightly softer because of higher interest rates, but there's still a lot of people making money and there's still a lot of demand for housing. Supply will increase but remain tight. Tight labor, supply chain disruptions, and semiconductor shortages will all play a role. Semiconductors are used in refrigerators and all kinds of appliances. So we'll see how that affects the economy, but I think the housing market is going to remain very, very strong. I'm predicting another 10 to 15% increase this year. Increases will remain above 5%, pushing many people to see the benefit of buying. Okay, so the forecast is mid to high single digit appreciation, 5 to 10%. I personally think it's going to be a little bit more than that. I think it's going to be 10 to 15%, and still a great time to create wealth by buying real estate. So if you're a homeowner, your values are going up, right? Your home value is going up like crazy. Now is a good time to tap into the equity that you may have. And let's take a quick look at how much equity there is in real estate in the United States right now. All right, guys, let's take a quick look at this chart here. The blue line you see there is real estate values in the United States. The real estate values are at $36.8 trillion. The green line at the bottom is mortgage debt outstanding. It's only 12 million. So you could see it's very, very steady. The red line is how much equity people have in their homes. There's $24 trillion in equity in real estate right now. This means there's going to be a lot of opportunity to take cash out of your homes to buy additional real estate, additional property, to buy crypto, to buy stocks, to start a business, to buy NFTs, to buy cyberpunks, whatever the hell you're going to buy or invest in. It's a great time to tap into your equity, use that to invest in something else because rates are relatively low still. But again, if you do a cash out refinance, do not pay points. Take a par rate or even get some credit, because at the end of the year, you're going to have a chance to refinance and lower your rate back down to closer to 3%, maybe even under 3%. So that's it, guys. That's a housing forecast for 2022. We'll see if it comes to fruition. Thank you guys so much for watching. If you found this video valuable, please leave a like, subscribe, and I'll see you guys on the next one.